Good morning. Africa Continental Free Trade Agreement, we're not going to discuss that in detail. You can go and read it on the web. But I think importantly is we're sitting here today and we are sitting in the UAE. So what we're going to try and do is link up between what that means for Africa and what that means for the greater MENA region. We talk about synergies between the two unions, Africa obviously and the UAE in terms of trade benefit. Is the free trade agreement something that would add value to this?
Oh, sorry. Yeah.
And I've really got two specialists on my left, and I'll introduce them shortly. But I think we're going to hone in on what the UAE and Dubai specifically can offer the African continent, how we gain and talk about risk mitigants, what the DMCC does in terms of innovation to make sure this trade agreement actually comes to the fore. But before that, let me just introduce to my far left Amir Hussain. Amir is he's a political and credit risk underwriter for Africa Specialty Risks. Africa Specialty Risk is the insurance company focused exclusively on the African continent, which is why we're here. Currently underwriting across 8 lines of business, including, amongst others, property, terrorism, you're a brave man, energy, as well as political and credit risk. And then on my left here, Sanjeev Dutta. Sanjeev is the Executive Director of Commodities and Financial Services at the DMCC. He's been with the organization for nearly 20 years and oversees the DMCC's commodities vertical. And he directs the development, implementation, and regulation of the organization's financial products, platforms, and services. And then last and not the least, I've got Robert virtually joining us. Robert, welcome. And maybe to you first, Rob, just talking to us about the AfCFTA and what you think, you know, the benefits. So where are we? We signed this in 2018 in Kigali. We had 44 countries there out of the 55. Everybody's talking about the $450 billion of benefit that we're going to get, cutting red tape, breaking down tariff barriers. And especially in the light of where we are, we're sitting in a commodity super cycle. We've had massive logistical challenges. We've had persistent high logistical costs, transports across borders. Maybe talk to us about that, and I would like to get your views about where we make the links between where we are today, where we're sitting here actually in Dubai, and then obviously what the scene is in Africa. Thanks, Rob.
Morning, Zhann, Sanjeev, Amir, everyone else in Dubai. Morning. Almost feels like I'm there with you with the excited countdown to day 2 from Vin. I'm just going to share my screen with you because sometimes pictures tell 1,000 words. And Zhann, the best way to come straight to your question is that the African Continental Free Trade Area, indeed, as Vin said, it is the world's largest free trade area in terms of number of participating countries. And it's just celebrated its 1-year anniversary last month. Trading has been nominally ongoing for 13 months. But actually, Zhann, the free trade area remains mostly symbolic, since implementation of the various phases has stalled during the pandemic. Phase 1 and 2 are done, but phase 3 is where we're stuck at the moment. In particular, this is negotiations on intellectual property and rules of origin for the automotive and the textile sector. In fact, the textile sector even more than automotive. And this has reached an impasse. Large economies like South Africa, Nigeria, and Egypt are pitted against smaller trade partners that seek greater benefits from the free trade area. And another concern has been that external parties like the EU, the US, the UK are continuing to push bilateral or sub-regional trade deals with individual African countries, kind of undermining what the free trade area here wants to achieve. Nevertheless, on the positive side, there have been significant elements of progress in AfCFTA implementation and broader facilitation of continental free trade. First of all, last month we heard of the Cairo-based AfCFTA launching the adjustment fund, or at least funding it to the value of $1 billion, which should address the needs of the private sector, including small and medium-sized enterprises. The adjustment fund also will help governments adjust to the loss of revenue from tariffs over the first few years. And then, again, AfCFTA facilitated project is the Pan-African Payments and Settlement System, PAPS. And this is being established to allow African currency transactions without conversion fees. So even though there remain many implementation challenges, negotiations are proceeding, and some key contentious matters, such as rules of origin, could be resolved in coming months. But you know, Zhann, I'm sure we'll talk about this shortly as well. is that if you look at Africa at the moment, it is divided in multiple economic communities. These are just 6 that I'm showing here on the slide in Central and West Africa. But there's a whole bunch more in the south, in the north, across the continent. All of these have their own trade rules, their own tariffs. That all needs to be synchronized with the new AfCFTA deal. So there's a lot of work to be done still, not just on the country level, but also on a regional level. And this divergence is also visible in economic growth rates. Africa has had some of the fastest growing economies in the world last year, but also a whole bunch of countries which are growing way below the global average at the moment. Countries like Angola, Republic of Congo, Equatorial Guinea, quite major oil producers, are struggling to come out of recession at the moment. And that's also a lot to do with COVID-19 vaccination. There are some countries really lagging, and then others, like Seychelles, which is the most vaccinated country in the world at the moment. For example, unsurprisingly perhaps, Seychelles now has scored a 7% GDP economic recovery last year. And other countries on this chart as well all have done well in recovering from the 2020 pandemic-induced slowdown. But also on here are a number of countries, which I'm sure you'll recognize from recent headlines, of political risk. Burkina Faso saw a coup just last month. Guinea saw a coup last year. Kenya's got some turbulent elections coming up. Benin saw some Islamist militant attacks in its north last week, and so on. So these countries, even though they are stellar, way above the global average for economic growth, they are suffering from a higher political risk profile. And this is also stalling some of the implementation. Nigeria, the biggest economy in Africa, was initially reluctant to jump on the bandwagon. And there are still some issues around border closures on the continent. Kenya and Rwanda may have opened borders, and Nigeria and Benin may have opened borders. But now, the economic communities that I was talking about earlier, like ECOWAS, is closing borders on coup-prone countries in West Africa. Mali is basically shut out from most of its ECOWAS neighbors. Guinea, the same. Burkina Faso may follow suit. The same could happen in other countries in West and Central Africa, where we've seen unconstitutional transfers of powers over the past few months. So, Zhann, there's a lot to do still in terms of implementation. I think my final point I want to make here is to say that it's not just opportunities, not just coming from free trade or the free trade agreement. If you look at supply chain challenges across the world, they're actually boosting local processing and manufacturing in Africa. South Africa, Kenya, Morocco, Nigeria are all seeing local sectors, a new opportunity for local sectors. Rather than importing from Asia, they're actually manufacturing and processing more locally. Similarly with the commodity rally, it's really enhancing the prospects of many of these African markets that I showed on the slide earlier. And Dubai is really at the center of the gold and metals market trading, as I'm sure Sanjeev will talk about shortly. And then in terms of what we also talk about this conference, digitization, supply chain optimization, tariff eradication, it's being driven at the moment mostly by individual countries or these individual trade regions, rather than the homogeneous 54-country AfCFTA region. And then maybe a final point to make, particularly as we're coming really close to the European Union, African Union Summit, I think they're starting to meet today in Brussels, is that individual countries and regions are seeking bilateral trade deals with external parties. Kenya is cozying up to the European Union. Many countries are looking at the US for the AGOA free trade agreement. So it's not just AfCFTA that's the key value maker here. There's a lot more going on the continent than just the AfCFTA. And in fact, some of the items I just mentioned are providing, in the short term at least, greater economic opportunity. So Zhann, I'm going to hand over back to you and your panel at the stage. And thank you initially for letting me join.
Rob, thank you. I find it fascinating that you make a correlation between the vaccination rates and the growth on continents, and there's almost a direct one-to-one correlation. Is that right?
Almost so, yes. So Africa remains one of the least vaccinated continent in the world. It's not really anymore a problem about the lack of vaccines. The vaccines are coming in. It's mostly a vaccine hesitancy, as well as a lack of infrastructure to actually distribute the vaccines across rural locations. So in many countries in Africa where we are seeing below average global economic growth rates, it's very much to do with the threat of continued travel restrictions and lockdowns. Fewer and fewer lockdowns are being imposed around the world, but in Africa, because we are expecting a fifth wave of infections by April or May perhaps, we don't know what variant there will be, and I'm sitting in South Africa, Zhann, just where you come from as well. Only 30%, 30 of the population is vaccinated. And that is causing hesitancy, not just in the local market, but also with foreign direct investors, not knowing whether South Africa or others are going to have to lock down again, or whether travel restrictions will be reimposed.
Sanjeev, I want to pick up with what Rob said about, and it's almost a windfall, right? So for the free trade agreement, it looks like the logistical challenges and the commodity super cycle actually almost enhanced and expedited the free trade agreement arrangements. Just in terms of the DMC and where you guys are located, do you see this and do you agree with Rob that the free trade agreement has almost got a tremendous boost because of challenges around logistics and maybe talk to us about digitization, because Rob mentioned that and I find it fascinating that would be something that you're pushing into Africa.
Yeah, I mean, good morning. It's great to be back. It's the first physical panel I'm doing in almost 2 years. So excuse my nervousness, but I'll try and be precise. So I work and represent DMCC, which is a free trade zone, and our passion is trade. So we are made for trade. That's the tagline, made for sustainable trade. And much of the success that we've drawn, when I say success, it's not for DMCC, but for trade, is connecting demand and supply. And coincidentally, demand and supply exist on either side of the center pot of trade, which we like to state as Dubai. Because, here, the thrust is more on non-oil trade than oil trade, specifically the economy of Dubai. We are not dependent on oil. We produce just about enough oil to fly our aeroplanes and run our cars. So there's a great bit of thrust on the non-oil economy. Now, Rob, he summarized it very well, like he normally does. There's no surprise. The free trade agreement has enabled us streamline. Now, if you look at much of the connectivity and the related issues that the African economies were facing, it was not to do with the sea routes, it was to do with the access to sea routes. Much of this agreement streamlines the trade corridors using rail and road transport, right? Now, typically, I'm talking about 7 to 8 years ago, we are home to the DMCC tea center here, for example. We were seen as more efficient in shipping over a box, which is a 40-foot container of tea, all the way to the UAE, packing it into tea bags. The Ghana market, for example, they buy one bag at a time. They can't afford a pack of 100 bags. So they'll go to the market, 2 in the morning, 3 in the evening, so on and so forth. There was a challenge in terms of packing those tea bags in Ghana. So those teas coming over to Dubai, getting packed and shipped back were quicker than movement within the countries. Take the example of Rwanda. It's a landlocked country, rich in resource, rich in discipline, rich in governance.
Connectivity, digitization.
Again, so if you see, the answer to all of this has been connectivity. The answer to all of this has been digitization, because today, like all of us, especially in the last couple of years, we've really understood and underlined the value of digitization. You want to do grocery, it's digitization, right? You're hardly making trips to the supermarket. Some of it through compulsion, some of it through awareness, and some of it through inculcated discipline, for example. So yeah, I mean, if you look at the African trade, the African market, the African opportunity, there's a huge tick on all of these. And the fact that you have a super agreement which tries to streamline and bring discipline and, sort of congregate the rich supplies, especially for us like DMCC, we are focused on not only the agri sector, where Africa is very, very important, but much of our focus is on precious metals and stones. So all of this with the governments trying, or some not, but most of them trying to sort of streamline the commodity supply chain is only good news. And how can we further underline that streamline? We talk of blockchain very regularly. That's the word which has been used so frequently over the last 4 years. If you can segregate, rather congregate, add a pedigree to those commodities, and of course, you're underlining not only the supply chain, but also further underlining stuff such as responsible sourcing, point of origin, traceability, responsible sourcing, all of it. Yeah? So I think it's a great time that we've come up with this. It's taken a little longer, but we have access to almost $3.4 trillion worth resources. And price discovery will come as well. So it's also about circular sustainability. If you talk about the lower value commodities such as coffee, etc., a coffee farmer or a gold miner always remains poor. But this reverse sustainability, more education, more visibility, more transparency will be a benefit across the value chain, not only downstream, but also people who struggle upstream.
That makes a lot of sense, but whilst we're saying that, I'm thinking risk, I'm thinking capital expenditure, FDI coming into these countries. Rob mentioned about people getting into in-country processing, value add, and it's not only about locally produced stuff. It's also about not just merely exporting raw commodities like cashew nuts, sesame seed, but adding value in country. What that will require is capex, right? So Amir, I want to talk to you about this because we just heard about coups in a whole lot of these countries taking place. There's national elections, which obviously has its own challenges. You guys specialize in risks associated with political risk, unrest, terrorism. If I were an investor into any of these African countries, setting up Rob mentioned textile, a cotton gin, a spinnery, a weavery, what have you guys done at Africa Specialty Risk to make sure that those investors can cover themselves in terms of political risk and maybe just the ecosystem of insurance in Africa and how that changed over the last 2 years? What's the community's perception of risk and premium?
Sure. Thank you for that, Zhann. Look, before I go into how insurance will help the African Continental Free Trade Agreement, I think it's important to reiterate some of the points made, and particularly mention one thing that perhaps hasn't been stressed, in that this agreement is not just designed to increase trade. The underlying goal is to increase foreign direct investment in Africa. And the type of foreign direct investment in Africa that it's designed to encourage is into manufacturing. Africa, as we've said, is very much reliant on raw material exports. Now, we've seen time and time again that that is unsustainable growth. It puts Africa in the way of external shocks. We've just been through one of the biggest external shocks, I think, in recent history. Now, why would people invest in Africa in the manufacturing sector? I think that is largely driven by the fact that Africa's competitive advantage as a continent is a young and ever-growing population. Now, what is the ultimate impact of that? There's a nexus between manufacturing and trade, which, when well performed, results in a widening of the sources of growth within the economy. It results in sustainable growth, and it protects countries from external shocks. Now, in terms of insurance, we see this as an amazing opportunity to help the growth and the industrialization and the development goals of the African continent. Why? Because, in particular, political and credit risk insurance speaks to the two things that will result in the success of the Continental Free Trade Agreement: trade and investment, foreign direct investment. So from a political risk point of view, the market has been covering political risks within the African continent and indeed throughout the developing world and sometimes also the developed world for decades now. The type of perils that we cover include very overt government actions such as expropriations, nationalizations, and also sometimes actions which are less overt but discriminatory in preventing businesses, especially foreign businesses, from performing their daily tasks. And that might range from inability to access foreign currency, inability to transfer hard currency out of a country. Indeed, there are other types of perils here, including political violence. So when investors from outside Africa look at the Continental Free Trade Agreement and see it as an opportunity to potentially avoid investing in a small country, but rather avail themselves of the economies of scale that would be available due to the Free Trade Agreement, these are the sorts of things that potentially, they're looking at country risk and what are the risks of a foreign government where they're investing, interfering with their assets and with their rights over their assets. So from a political risk point of view, we see this, again, I reiterate, as a great opportunity to help Africa and Africa's development. In terms of the more immediate benefit of the Continental Free Trade Agreement, i.e., trade across borders, credit risk, and in this case, trade credit risk insurance, it's been part of the framework and the fabric of international trade, I think, since the 30s and perhaps even before that, 30s when the Berne Union came together and there was a greater impetus towards insurance. Indeed, the Lloyd's of London market is pretty much based and has developed out of trade credit risk insurance. I think the difficulty here potentially is that underwriters are very much used to insuring from outside Africa and looking at entities which perhaps have greater substance because they're quite used to looking at entities in their own home countries. African companies who are likely to be insured as a result of the Continental Free Trade Agreement may very well be smaller. But I think, if you don't mind me saying, it's important in those circumstances to actually deal with specialists in Africa, such as Africa Specialty Risks. What we're trying to do is, by focusing on Africa, we're trying to develop a specialism and apply our specialism, know the countries we're dealing with inside out, and really not just rely on the financial numbers. Quite often, the numbers of the companies that an African company may be selling to, or a non-African company may be selling to, may look very weak. But when you actually go there and look at the infrastructure, you realize that it's actually quite substantive for the local setup. So, political and credit risk insurance is here to help. I think it's helped significantly investment, FDI into Africa. The Continental Free Trade Agreement represents a way to enhance that and take it forward, and we're hoping that we can continue that help.
Rob, I see you mentioning or nodding in confirmation there in the background. We saw the growth numbers. What is your view in terms of, and obviously I know you're not putting yourself out as an insurance expert, but your view in terms of Pangea talking to investors around is insurance that an important tool? Is it an enabler for FDI and investment on the continent? And does it then link up to your growth rates that you showed? You mentioned the 6 different, let's call it, trade arrangements in Africa, and then obviously the strife between the competition of people wanting to sign bilaterals. Maybe just your view on that?
Thank you, Zhann, for bringing me in. Yeah, you can probably see me shaking in agreement behind Amir's shoulder there. I'm really happy that the point about FDI has been raised. People are always trying to rate trade agreements based on the success of seeing an increase in trade volumes. In Africa, if we're not seeing an immediate intra-regional trade volume increase, people externally assume the AfCFTA is just not successful. That's not what we're trying to achieve here. It's a longer-term plan. Everyone who signed or came on board here in 2018-19 realized that this is about attracting foreign direct investment in the longer term. And you know, one of the advantages about joining you virtually is that sometimes you can just quickly dig something up and then show it to the audience like I'm doing now. I probably should have put that in my presentation earlier. It's a map of, particularly where DP World, but also other Middle Eastern companies are setting up their ports. And here you can really see, particularly in the Horn of Africa, but also in the west and the north of Africa, that DP World and other Middle Eastern companies are already filling that deficit of infrastructure on the African continent, making huge investments across the continent in transport infrastructure, particularly marine, like Sanjeev said earlier. This is a key development. And DP World, together with the UK CDC group recently, made huge commitments for several African ports, including in Somaliland, for example, connecting Ethiopia to the coast, to the Red Sea. In terms of your question, foreign direct investment comes with huge political risk in Africa. Just look at what Total is facing in northern Mozambique, for example, or what mining companies are facing in the Sahel. Doesn't necessarily mean that political risk is going to impact you commercially, but risk mitigation factors need to be put in place. And in terms of your direct question there, Zhann, at Pangea Risk, we always recommend our clients to look at risk mitigation factors, whether that is a security risk audit or setting up introductions to insurance brokers and underwriters who have specialized years and years of expertise in putting together cover for clients when they bring in foreign direct investments into Africa. The key point here is that just because there is high country risk does not mean that your investment is directly at risk of that peril. But it's important then to actually analyze the situation, sift through all the noise, and then make sure that you have the right risk mitigation factors in place, like, for example, political risk insurance.
Thank you. Sanjeev, I want to come to you and talk a bit about what you've seen in the last 2 years. Coming out of the pandemic, flow of commodities, we're talking about value add. Is that something that's a reality on the African continent, or are we just sitting talking about this and hoping it would happen? Are you guys seeing that? We just saw DP World and obviously the expansion going on there, the massive capex investments in ports on the African continent. The question is it happening, or are we dreaming and hoping for something to happen?
I mean, it's certainly happening. Now, over the last 2 years, you know, the circumstances and the pandemic has only underlined a lot of what we've been talking about. Now, DMCC does a thought leadership piece. It's called the Future of Trade Report, which we've been working on since 2018. Every year we publish that report. It's a focus group-based knowledge research. So it's not just us publishing. We, of course, don't write and mention names, but it's a thought leadership piece where we go across several cities every year. So far, we've covered in excess of 40 cities. And we talk about certain aspects that we believe trade will face. One of the jargons which came out in last year's report, of course, access to trade finance has always been an issue. There's a gap of some $1.4 trillion between demand and supply. We've talked about a jargon as, you know, localization is the new globalization. That we talked about in the 2019 report. The bad coincidence was the pandemic. And here you are with the rising cost of shipping, the unavailability of shipping, for example, for moving commodities across globally, has only given rise to that same jargon that you've got to produce locally. Give your local economy the boost, you know, devise your tax structures, you know, tax subsidies, tax holidays to encourage local investments, and the value add stays in the country as opposed to the cashew nut story, which you just mentioned. So yeah, to cut the long story short, entities such as DP World are not only investing heavily in the infrastructure, but also in the ancillary stuff. Now, DP World have formed a trade finance organization. So they don't only want to provide the port, they want to provide the infrastructure surrounding the port in terms of the warehousing, in terms of inland. You've heard about the Hyperloop, which the chairman of DP World, His Excellency Sultan bin Salem, also chairs. It's all about moving goods from origin to consumption, quickest, freshest, best trade route at the most optimum cost, and trying to pass those benefits on to the eventual consumer. So yes, what do we need to watch out for? Giving impetus to the local producers, farmers, miners, whatever name you want to call it.
Provided quality and traceability, right?
Absolutely. And traceability, reverse, circular sustainability, these are all huge words, but you can actually see these happening. Consumerism is changing. It's not about what you consume, it's about how you consume it. Today, if you're going to a diamond store, we've seen that, and that's also underlined the emergence of lab-grown diamonds, as long as you declare them separately. When you talk about UAE's efforts in the precious metal sector, I'm not here to talk about it, but you see the announcement of the UAE Good Delivery, where the government of UAE is taking a united stand when it comes to the tradability and the traceability of the precious metal. We've had several webinars where our chairman has led talking about the prevention of hand-carried gold. We are not allowed to carry a bottle of water into an aeroplane. How are you then allowed to carry gold into the aeroplane, where the mercury which has gone into producing that gold has an impact on the overall body of the aircraft, which is manufactured in aluminum predominantly. So, when it comes to DMCC, Dubai, the UAE, in general, is very conscientious about pushing this agenda forward, pushing the agenda forward in terms of trade, linking, helping, using our soil and our infrastructure to provide as a gateway for commodities, especially which Africa is so rich in, to the rest of the world. Also enable them discover better prices. That's important. The farmer is used to selling a commodity at a particular price.
Stays poor, right?
How can we get that person a better price, a more sustainable price, rather than the middleman making all the money? So that's the story, and that's, I think, the effort which the UAE really leads well. And I'm so fortunate to have seen all of that, not only in terms of the free zone setting up, but in terms of these investments going in from entities such as DP World, so on and so forth.
And naturally, you have to link up with a free trade agreement to make sure that happens, and that you got support in country, right?
Absolutely. I mean, if you look at the kind of bilateral agreements that several entities and institutions are signing up for, so it's more trying to add substance into every aspect of trade. It's not just signing an MOU or signing a bilateral agreement, but then following it up to try and see what we can do. I mean, we are very actively involved in dealing with the leadership across most countries in the African subcontinent, only to give them that impetus that they've needed for so many years, to give them, their share of dues, because there is the concentration of quality in that continent, but doesn't get recognized.
Yeah.
So how is it that we can use ourselves as a fulcrum or a lever to ensure that happens?
Amir, I'm not going to put you on the spot. You don't have to claim or quote premiums and rates because it is recorded. I was thinking about FTA going into countries, more and more investment. You're diversifying your political risk base. You are making it an acceptable, let's call it practice, to spend a huge amount of capital, long-term capital in certain countries. Is there an impact on your assessment of risk? And I almost want to say the more the merrier. So if these investments are increasing in continents, in countries, or people doing more and more to invest locally, how does your perception of risk in that country politically and for terrorism, credit risk even, how is it impacted by the quantum of investment coming in?
No doubt it's positive, right? Because if investors have made investments in the country and have profited from it without government interference, without recall to insurance or other risk mitigation techniques, that's no doubt positive, and it encourages further risk mitigation, provision of further risk mitigation.
And is that it's almost like a herd mentality, isn't it? I mean,
well, sure. Well, look, I mean, every country is looked at on its own merits. Every country, you know, the continent is 54, 55 countries. Some of them because they're either going through civil war or because, you know, the government's behavior towards foreign investors has been very adverse, or a little bit off risk. Others which have attracted foreign direct investment largely because of their policies to grow the underlying sources of their economic development, they are continuing to encourage more investment. I think the Continental Free Trade Agreement will definitely, provided the roadblocks to the African Continental Free Trade Agreement are removed, will provide greater impetus to that. But yeah, the more the merrier. But again, every country and every risk is assessed on its own merits. And look, I mean, the reality is that some industries are more amenable to investment, such as telecoms. Others, they are more difficult and more circumspect. But nevertheless, I think, I go back to the point that's just been made. The goal is local manufacturing to provide the best transactions and best deals for the local population. If we see that happening, then we're more than willing to try to risk mitigate.
Excellent. I'm cognizant of time, so I would like to hand over to questions. Jeff, I don't know if you've got anything on the system, or maybe even questions from the audience, to see if we can maybe answer some specific issues that associates itself with the free trade agreement, and obviously for the panelists here. Rob, while we're waiting for the questions, I want to come to you in terms of the progress of countries, providing the instruments of ratification. In 2019, we had only 24 out of the 44. As COVID accelerated that, where are we in terms of countries now firmly putting their money where their mouths are?
Good question, Zhann. That map I showed you earlier at the beginning of my presentation, I'm happy to forward that to anyone there as well afterwards. We just updated it this week just to make sure we were completely up to date before doing this quick presentation. Last time we did it was 6 months ago. And since then, the map has actually changed quite significantly. Quite a few big countries, big economies, like Algeria, for example, now fully ratified with articles deposited. There's one country which hasn't ratified the whole deal yet, and that's Eritrea. Eritrea stuck between Djibouti and Ethiopia, and it's a very isolationist country. It was always going to be laggard in terms of joining a free trade deal. But now, because of the Belt and Road BRI initiative, which Eritrea has joined, and tapping into the Horn of Africa infrastructure projects, like those that DP World is sponsoring at the moment, Eritrea is now actually also considering joining it. So very soon, all 55 African Union recognized countries in Africa will be part of the AfCFTA. There's a couple of laggards still in terms of ratifying, but we're almost there. So I think countries like Botswana or some other stable markets still need to fully ratify it, but we're almost there.
And how big do you think the international community is driving this ratification, the role that played? I mean, yes, it's obviously an African thing, but what I'm seeing is that international influence playing a massive role in terms of countries now being not forced, but being actively encouraged to ratify themselves to actually be part of this global picture.
It's a bit of both, Zhann. What we're seeing is, yes, I mean, this is not just African Union initiative. It has buy-in from many other international partners, trading partners, economic communities around the world. Africa and the world realizes that Africa can only compete as a trading entity, as a trading region. On the other hand, we are, and I think I briefly mentioned this earlier, so the number of external actors, like the European Union, the UK, and the US in particular, are putting pressure on individual African countries to sign off on bilateral trade deals. The US has been pushing Kenya on a deal that essentially goes against the grain of the East African community and also of the AfCFTA. Similar disputes are happening about countries that are part of the African Growth and Opportunity Act with the US, where many of these smaller countries like Togo, Benin, Eswatini are keen to stick with the AGOA terms, whereas South Africa or other major textile producers on the continent are hoping that these deals will actually fall into line with AfCFTA implementation. At the moment, regional economic community trade deals supersede the terms of the AfCFTA. So there's a lot of paperwork still to be done, Zhann.
Excellent. Jeff, any questions? If there are no questions, then it shows that the panelists have done their job brilliantly, but...
Is this on? Can you hear me? Great. We've got one question through the app with regards to MENA, and this is concerning, I guess, MENA defined as North Africa. Are we seeing greater alignment between the MENA region and the West African market, in particular, following Morocco's joining of ECOWAS?
Sanjeev, that's clearly in your valley.
Yes, I mean, overall, if you see the sentiment's really positive here. And with these positive developments in terms of free trade agreements, in terms of what's happening within the continent, part of that discipline is cascading globally. And of course, when Robert makes a point, in terms of some of it is being advised to join and some of it is becoming, imperative. So when you take all of that into consideration, it's only going to structure trade flows globally.
Great stuff. I want to thank the panelists, Rob, especially you guys, dialing in from very far away. Thank you for making yourself available. And Sanjeev, Amir, thank you very much.